Dow Jones was down 2.5%, NASDAQ was down 4%, SPY is down 3.5%, and some stocks are down double digits. It almost seems like a new stock is down double digits every single day. So what's going on with the market right now, and what can we do about that? Hey everyone, Steve here. So it's been a little bit of time. I've actually been house hunting on the East Coast. So thank you for your patience as I've gone through this weird transition in my life. It's been very, very tiring to find a house on the East Coast with all this issues with so much demand, but so little supply. But anyways, let's talk about the current market and what's going on. So as you might have heard, a big part of this is actually due to rising interest rates. The Fed has actually calculated that it will raise interest rates several times this year, anywhere from 0.75 to 1% overall. Part of the issue is that due to this inflation, it actually raised the consumer price index by 7%. By the way, the CPI is measuring how much everyday consumption goods like milk, eggs, gas, etc. cost and how much they're actually rising in price. Now the issue is, since the CPI rose by 7%, there's fear that the Federal Reserve might need to actually increase interest rates higher than 1% or 0.75% by end of year. This unfortunately means that if you didn't get at least a 7% raise last year for this new year, that the price of these items are actually going to start eating into your paycheck, so you're technically getting paid less. Now, interest rates are crucial for business because when interest rates are low, money is really cheap to borrow, and thus more businesses and people borrow money. For example, a person like me, I'm actually fearing the interest rate rising because I'm about to buy a house, right? So if interest rates are going to go up, it's going to cost me more to pay interest to the bank when I'm paying off my mortgage. Now for companies, when interest rates are low, obviously, again, like I mentioned, it's cheaper for them to borrow money, so they tend to borrow more money, and that helps to spur the economy. The issue is when interest rates get high, especially for tech companies and growth companies that sometimes have really low profit margins, they end up getting pulverized. This is especially true for companies that have very thin margins because, for example, they can't afford to pass these extra costs onto the consumer for their product, because if they do, the consumer might leave them, go to their competitor, back out. So these are things these companies have to keep in mind if they were to raise their prices to keep up with the inflation. Look at Roku, for example. It has stiff competition, and this tight squeeze has caused its streaming hardware service or business to turn margins negative. Now remember, a lot of these stocks that we're looking at have very high PE ratios. For example, if we have a company that has an earnings per share of $2 and a stock price of 100, that means the PE ratio is $50. That means people are willing to pay 50 times the company's profit for one share. So obviously they have high expectations. In case you want to hear more about PE ratio, I do have a video on that, so I'll link to it on the top right of this video. So think about it, right? The PE ratios are super high. People are expecting the company to do really well. Otherwise, they wouldn't be paying so much money for only a small portion of the company's earnings. So we have high PE, which means high expectations, and all of a sudden interest rates are rising. As we talked about, when interest rates are low, businesses tend to, the economy tends to spur because people can borrow more money, it's cheaper to borrow. So when interest rates are high, that means that companies are not going to want to borrow money because it's more expensive to do so. And so that company might either plateau or they might decline in their business. So you're paying a super high price for a company that might be plateauing or going down because of interest rates and them not trying to expand or take any unnecessary risks. And then the value of your money is also simultaneously going down because as you know, when interest rates go up, the value of your money goes down. So investors have to keep this in mind because if they're not seeing a high rate of return or really risky trades, then they might back out, and that's where this sort of thing happens where all these stocks start to tumble. There's also the concept of real returns. So imagine the S&P has an annual return of, let's say, 7%. If inflation is 2%, your annual return is really 5% in real returns. Now imagine inflation jumps to 5%. Even if the S&P did 7%, your real return is now 2%. And keep in mind, there's no guarantee with the fear of high inflation that the S&P will even perform at that level to begin with. Now take this fear to growing companies which need the money that they have to take out to grow, which they can no longer do because of high interest, and speculative companies which have crazy margins that are not going to work with this higher interest rate. And many investors realize, hey, it might be safer to put my money elsewhere. Okay, now the big question I know you've been waiting for, what do we do here? What do we play? How do we utilize this time to make money? If you foresee that this volatility will increase, I recommend trying out VIX. It rises as volatility rises in the S&P. And there might be more opportunity here, but keep in mind, these plays tend to be a little bit more short-term because once it shows a sign of recovery, then this stock can drop dramatically. So be careful if you do decide to play VIX. I also want to give some caution here. The market is very volatile right now. There's no guarantee it's going to go up or down, as you know. So please be careful with your trades. Please don't make any large trades with money that you can't afford to lose, you have to invest smart in these situations. I'm more of an internal bull, so I'm looking for those positive swing trade opportunities. I don't really like to short or buy puts that much, but there is opportunity for it. Remember, like all things, this will eventually pass, but companies that have crazy high PE ratios, they might be beat down a little bit more, so please be careful with the stocks that you're investing in. You can quickly Google a stock's PE ratio to kind of see how speculative it is. So one example, one crazy example, of course, is Tesla. Look how high that PE ratio is for Tesla. Let me show you a few stocks I'm looking at, and before you even jump into that, please make sure you understand my trading methodology. If you want to learn how to trade like I do, I have a video that I posted about Webull on how to trade, so you can take a look there. It's on the top right of this video I'm looking at now, so jump there first in case you need a refresher on how to trade. Wow, so the market just closed today. Amazon's down 200, which is just nuts. That's a huge drop there. But you can see, even for stocks like Amazon, it still follows my pattern here. Once the stock started trading under the, let me zoom in here a bit. Once it started trading under the 200-day SMA there, it was really a time to not get in. And especially when it went under the 9-day SMA, which you could have seen that, I mean, it went under here, it rose back up here, went under, downward trajectory, and then once it went under the 180, you have to get out. That's the time when it gets really risky, and that's exactly what happened. You can see it went from 3393 down to 2,852, which is just insane. So it's a little bit tricky here. One thing I hear a lot is, you should invest in banks because banks are the best thing to do when inflation is high. But even banks like JP Morgan, you can see that had a huge fall. And the problem is, look at this, right? So if you followed my pattern, you would have entered maybe around here. You would have had a nice run up here. And then out of nowhere, it just dropped dramatically here and went not only under the 9-day, but also under the 180 here. So net, you would have been you would have made profit here because if you entered here, you would have entered around 157. If you didn't take profit up here, you would have got out maybe around in the morning at 160. So you still would have been positive $3, but still it's quite the drop. And if you didn't get out and just held, then that's where you end up becoming a bag holder and have huge issues where you'd be 145 over here. So I would say watch JP Morgan because I'm curious to see how it will come back. Again, it's nowhere near a point to enter, but as it gets more stable and hopefully things pick up in terms of them lending out more loans and everything for higher rates, they're able to bounce back here. So we'll see what happens with JP Morgan. Next up is Adobe. So the ticker is, ADBE. So they've also had a huge drop. A lot of tech companies have. So I would say now is still a time where they're a little bit bearish. You can see again, they're under the 180 SMA line here. Once it happened, it just started going down and down and down. So again, watch as it comes back up. If we jump over to VIX real quick, as I mentioned, you could see that once it crossed over around here, that was a good time to get in. And if you followed that up, you would be around this point here. Again, I don't think this is like a long-term play. In the next couple of business days, it might start to either plateau or kind of decline. But again, it depends because you saw how huge the fear was today. If we jump over to SPY, you can see that it's bouncing, or it actually broke through the 180 here. So again, if it continues to go under the 180, that's a very bad bearish sign, and that's not very good for us. So we have to watch out for that. So again, you want to make sure that whatever stock you're trading is above the 180 and then had a recent crossover over the 90. So these are all, you're going to get a great deal when this recovers, but for now it's risky. So just let it drop, let it fall. And it's better to catch it on the way up when it's actually showing signs of recovery than securing yourself a great deal that you think is a great deal. And then it keeps on going down and down and down, and then you start to panic. So you have to be careful about that. Okay, so if we look at Apple, Apple is one of my favorite stocks because it's very easy to sell options on this stock. And it's fairly consistent in terms of its movements. So as you can see here, we had a great entry point when it went above the 9-day. It's above the 180 and everything else, 50 as well. Easy ride up, didn't go under, continued. And then at this point here, you would have got out. Again, if you entered here, you could have rode up a little bit here and then got out here. Once you got out when it went under the 9-day, again, it kind of just plateaued or traded a little bit sideways and then went down. So there was no real clear point to get in here, maybe here, but still it didn't fully close above, or didn't open rather, above the 9-day. So that wasn't the best time to sort of enter, nor did it close above the 9 days. So it's a little bit more risky to enter here. So then it kind of went down from there. So I'm going to be waiting for Apple. I think they're one of my favorite stocks when it comes to them consolidating. And once they do, then I'll wait for some, a little bit for it to trade sideways for a bit. And then when it starts rising back up above the 9-day, that's the time to get in. Again, look at these plays for the MACD and everything too. It works really well. So I'm hoping that in the future it will continue to do that. So again, you can see that divergence here. The MACD crossed over at one singular point right here, and then it just went down and never crossed back over again. So when the MACD finally starts to consolidate and comes back closer, this is one of my favorite plays for a swing trade. So you can just jump back in there when it's above the 9-day. It's above the, hopefully still above the 180. MACD crosses over and RSI is below 50, which at this point it's at 35. So still very low. Another stock I'm interested in, and this one is kind of a very speculative one, so please bear with me here. This is one of the most volatile stocks I've traded in a long time. So as you can see, it had a high of 490 at one point, and from that point onward, it was kind of on a downward trajectory. Once it crossed under the 180 here, that was kind of a sign that, this is going to be a very risky stock to be playing, but it continued to kind of drop down from there. So I'm curious to see what Roku will do in the future. I think that, again, I wouldn't touch this with a 10-foot pole for probably another 3 or 4 months, but I'm just curious to see how it will recover, if it recovers at all. I think one stock you're probably aware about, if you don't already know about, is Peloton. Peloton has been having a huge issue. I think they recently reported that they're having issues with their bikes in terms of selling them, and they actually had to halt production. So they're having a huge issue. And I remember on Steve's stock picks at one point, I was telling you guys to, look out for Peloton, to short it at one point, and ever since it was around 110 or whatever, and since that point, it's just been proving over and over again. It's just one of those COVID stocks that it was all hype, and now it's kind of dying out, and the business itself is not doing well at all. So don't play Peloton. I just wanted to kind of show you guys again how these technicals kind of come to play, because you can see it was kind of working itself downward, and again, it didn't really ever cross over the 9-day here. It just kind of stood on this line. And even though the MACD had a crossover here, it wasn't really going over, and there was no trajectory upward. So it was kind of on the line itself. So you have to watch out for those as well. And the last one I want to talk about is Salesforce. So Salesforce is one of those companies that they have a very strong subscriber base, and obviously the whole market is kind of reeling right now, but I think that they do have strong financials in terms of a comeback for themselves. So it's one that, again, a lot of these stocks are nowhere near where we want to be for buying in or purchasing. But again, it's just interesting to watch how they sort of pan out and how low they're going to go. And then again, once they cross over that 9-day, you can try to enter. I think, again, the best point is if it's over the 1 or the 200 rather, and the 9-day, if it's over both of those, that's really a good sign for you. Otherwise, if you're just doing over the 9-day by itself, that's a little bit more risky. So be careful with that. But yeah, so I would say the 3 stocks to watch out for me are Apple, Roku, and Salesforce. So keep an eye out for those. Keep in mind the stock market might play with your emotions, so it might drop another 10% today, and then tomorrow be up 20%. It doesn't really mean that you should make certain moves. You should really just look at the trend and just analyze the trend overall. That's the most helpful thing during this, because if you play with your emotions, you will lose. You're competing against algorithms and machines that make decisions in half a second, that have no emotions, that are cold-blooded. So you will lose if you try to play emotion trading. Do not do that. Also be aware of dead cat bounces. That's a situation where, again, a stock all of a sudden, it'll rise, it'll drop, and then it'll bounce up. And then during that bounce up, people are like, oh wow, it's coming back. Like, let me get in. And then it drops again. That happened with Roku. I can show you an example here where it was just down, down, down. All of a sudden it just spiked, and then immediately just dropped again. So that's considered a dead cat bounce. So please be careful with that. That can really mess with your emotions. That happened to me a couple times. I'm not always a perfect trader, and that definitely hurts. So be careful with that. Thanks so much for watching. It feels good to make another video here. I'm gonna try to just make videos as I can. I think doing the whole 2-week thing was a little bit too expectant of me, and I just had a lot of things going on with my 9-to-5 job, as well as, again, I'm moving to the East Coast, so there's a lot going on. So I'll make videos as I see fit. Thank you guys so much for trusting in me and for subscribing to me. It really does mean a lot. I would like to know what you guys are keeping in mind for your trades. Let me know what tickers you're looking at as well and why. But again, thank you for watching, and as always, keep on making great trades.